Hello, welcome back. We're going to examine Pinduoduo, a well-known Chinese e-commerce company that has been slumping a little bit and it's been going down and down with the rest of the Chinese stocks, I suppose. This was a suggestion from one of our subscribers and viewers of the channel, so thank you for that. Hopefully that video will help you a little bit with your decisions. We're going to examine the company as we usually do, and at the end we're going to have a discounted cash flow model to help us identify what's a good price to pay for the stock. Now, first things first, we always start with outstanding shares just to see how they're growing or shrinking. As you see here, the company has been issuing shares, and this is something that you shouldn't like as an investor. They used to have about a billion one shares, and right now they're approaching billion three. So they have printed about like 20% of extra shares here. So that's quite a lot. And they obviously try to take advantage of the increasing prices here, I'm pretty sure, as a lot of companies do. But I would expect this to slow down, especially right now that the company stock price is actually shrinking a little bit, actually massively, because it used to be about 200 plus over here. Now, that's not gonna be the thing that will stop us from investing in the company, but it's something that we need to keep in mind. The next thing that we're gonna examine here is the income statement of the company, and it's worth noting that the company is sitting at $57 billion for a market cap. I love the year-over-year growth of revenues here. This is absolutely insane. Look at that. From 268 million in 2017 to 14.4 billion in the last 12 months. That's outlandish. That's like an insane amount of growth over here. Insane, absolutely insane what they're doing here. Awesome. And the gross profit follows here, pretty much increasing tremendously over the years. They're doing really well in terms of that. And the net income of the company is negative, however. So that's something to keep in mind, that they are losing money, but they were losing way more than what they are losing right now. And net income can be skewed a little bit with a lot of different things like depreciation or amortization, and some expenses can actually be paid paid in a few months from now or paid in the next year or so. So it can give us a skewed picture. What we really want to examine is the cash flow really for the company, and the balance sheet is what's gonna follow here, with the total assets of the company from $2 billion to 26 almost $billion in the last 12 months. That's amazing. And the total liability sitting at 16 billion, which is less than the total assets. What about the total equity though? It's 10 billion, 10.5. So the company has a lot of liabilities when you compare it to the total equity of the company. So they have 15.2 and their total equity is 10.5. That's something to note. But it's better to use the cash flow of the company to account for total liabilities, because that's the cash that the company makes to use for repaying debt, for example, or paying dividends or acquisitions and things of that sort. The cash flow statement here shows us a company that has grown actually the cash from operations from 1.5 billion to 4.2 billion in the last 12 months, which is great. And also investing in market securities, another good thing. Now, they may be overdoing it a little bit, because I'm seeing for the most part investing in market securities and not much in capital expenditures. So they are acting a little bit as a hedge fund over here, so something to bear in mind. Cash from financing, it is positive here, and the reason for that is the issuance of common stock. So that's something to really take a look at and understand, because they have issued almost 6 billion of 6 billion worth of shares over here, and 1.1 in 2019. So they are financing a lot of their operations through basically issuing shares, common stock. They took advantage of the rising prices, really. That's what happened. But what about the free cash flow, which is very important, because free cash flow is what? It's like cash from operations minus capital expenditures, and the capital expenditures of the company are almost zero. So everything from cash from operations is actually kept as free cash flow, and that's amazing. We're looking at 1.4, 1.1, 2.1, 4.3, and 4.2 in the last 12 months. That's a great growth for free cash flow, and it's actually really good free cash flow regardless. Like 2 billion, 4.3, that's an amazing increase here. So that's great to see for the company. What are the multiples of the company here? 3.3, 2.8, 4.2 is basically about where I would want them to be. Anything near 3 and less is better, of course. The profitability, yeah, I would expect this to be negative here. This is something that you would kind of expect right now from the company based on what I was saying from the net income that they're making. It is negative, but it's probably not something that worries me too much right now, although I would want it to become positive at some point for sure. Many of these companies, even Amazon or Alibaba, tend to have low return on equities, really, and it's sort of like a thing that you see with the industry, really. And I'm not that worried about this figure personally. And the total debt to equity shows a company that doesn't have too much debt here. 18% is actually less than what it used to be. So they seem to be repaying back some of their debt or getting more equity, which is probably the case here just because they issued a lot of shares. So I think they actually have a lower value here because of the higher equity. That's what's happening. And we're going to move forward to the cash flow model here, the discounted cash flow model. And I have already copy-pasted the values, as you can see here, from the free cash flow, plus the outstanding shares in million here, which is 1.25 billion shares that the company has right now. And the 5-year average free cash flow growth of the company is sitting at 42%, which is great over here. So we're going to use, for the next 10 years, I'm going to go like 15%. It may be a little bit too much, it may be a little bit too confident, but I'm going to try a scenario of 10% a little bit later. Let's just start with 15%. And a discount rate that I usually use is 13%. A perpetual growth rate of the company perpetually growing at about 2% is fair. And you will see here that the price to pay today for the company is $74.73 in order to achieve 13% annual gain from our investment in the next 10 years. And so if we take a look at the company, you'll see that it's trading at 45 over here, which is way, way lower than this figure. And this means that it's a go. I mean, it looks like it's a good company to purchase at the current price, and it's actually cheap to purchase at the current price. Now, if I use a free cash flow of 10%, what am I getting? 53 over here. So even at 10% a year, I am actually still above 45. And if we got the current price, we could try something like 7% here, and we're sitting at 43. Remember, the current price is 45. So right here, we're about where we'd want it to be. It's actually the current price. But we're using a free cash flow growth of 7% here, which I think the company can easily achieve in the next 10 years based on what they have been doing in the previous years. They have been enjoying quite a lot of free cash flow growth in the past few years. So 7%, and this is how it would grow over the years. So you're looking at year 5 today at 4.2 billion, and year 10 in the next year, 10 years from now, is going to be 8.3. So it's basically doubling. I think that's very achievable, probably very easily achievable for a company like Pinduoduo here. That's what I would expect. And they may actually be doing better in the next 10 years, but again, we're trying to be conservative here. So for a free cash flow of 10%, which I think is what we should potentially go for, and the company making about 11 billion in the next year 10 really of its operations, we're looking at a company that's going to be having a 13% gain for our money. That's what we're projecting here, gaining 13% on our money for the next 10 years, and we're looking to buy it at anything below $53. And again, it's currently sitting at 45.23. So it's a go. And at the end, I have to say that I like what I'm seeing here. I like the company, and I think I'm a buyer of this. It looks good to me, and it looks cheap right now. So I would definitely think about potentially adding this to my portfolio. Very interesting company, and making tons of cash here. And it looks cheap, and based on the current price, I mean, it's been down tremendously. You'll see here that it's been down like 70%, 73%. This is insane. I think that's a good, actually, potential price to buy over here. It looks like it's a good value investment at this level. I'm expecting that it may actually potentially even go lower and reach these levels. I wouldn't be surprised. But for holding long term, I think I'm in. I mean, this looks really, really good. They're growing tremendously, making tons of cash. So why not? Tell me what you think about Pinduoduo. Do you own it? Are you thinking of purchasing? And again, I have to thank our viewer for suggesting this. Looks like a very, very interesting opportunity. I wanted to take a look at Pinduoduo, a very well-known company. It was on my plans, so thanks for reminding me. And hope you enjoyed the video. If you did like this one, take a look at this video that I made earlier. I'm discussing Alibaba and addressing some of the concerns that people, normally have because the price has been going down and down. So take a look at this one. I mean, I think it's gonna be very, very useful to you and kind of give you some confidence if you are an investor and you have been losing money for a long time now. Thanks for watching this. See you in the next one, guys. Bye bye.